Hey everyone, it's Larry Berman here. I'd like to wish everybody a happy new year and ask you why you're watching a video today if you're celebrating. Anyways, just having some fun there. It's a time of year in the Jewish faith for reflection and family, and I'm going to be spending the next few days with family. So looking forward to that. And the rockiness of the markets that September and October often bring. Recording this Friday afternoon, September 15th. So it's the what anniversary is this? The 2007 16th anniversary of Lehman's bankruptcy, and that was a date that changed the world. So, lots of reflection today on that as well, and what it meant when Wall Street, got greedy and the financial markets got leveraged. And today there's some similarities, there's some stark differences, but you have systemic challenges, and some of the biggest are within politics and geopolitics. So we're going to take a dive into the chart room and see what we learned this week. Consumer sentiment numbers came out disappointing on Friday, but the inflation expectation component was bullish. And initially, the markets had a little bit of a shock down and then a move up. And of course, all we'll know now by the end of the week, gave back all of the previous week gains. And so September is off to a rocky start. It shouldn't be surprising. Our pro-eyes indicators are giving us cautionary signals, have been now for a couple of weeks. So not too surprised to see that. When we dig down and we look at the consumer sentiment numbers, obviously off the lows from last year, we had a bit of a rally. Quite surprising, actually, in terms of the inflation expectations, because when you ask that survey question and people see what they're paying at the pumps and still at the food stores, it's hard to imagine why sentiment is really strong, save for the labor market that continues to trug along and, give people jobs. So having said that, United Auto Workers this week went on strike, rotating strikes, a lot of commentary on how long it might last. I believe they're going to go tooth and nail here down to the wire. They probably end up meeting in the middle, but I can't imagine being so far apart on so many numbers that it settles anytime soon. So some time's going to have to pass here. There's going to be some pain, downgrades to economic numbers. Now, these are transitory, unlike what the Fed believed inflation was. So as soon as everyone gets back to work, production will come back. But in the interim, certainly adds a little bit of uncertainty. I wouldn't trade your portfolio around it unless, of course, you've got positions in some of the auto names. And we did see a lot of those stocks bounce Friday. Okay, interest rates. So last week we talked about more supply coming. That hasn't changed. We suggested that if this week we were back above 440, in particular higher than we've recently seen, that there's probably another leg coming to the upside. And so what is the biggest catalyst for that, in addition to the supply, which we know? Okay, certain we're going to get massive supply over the next several years as the U.S. needs to refinance the debt. So here's the wild card. The political bipartisan rhetoric anti-China is growing. You're seeing China convert from an exporting nation. So this devaluation in the Chinese currency was a big part of China's restructuring to become the manufacturing hub to the world. And so they no longer have a need or desire for a weak Chinese currency, because that game from then being the exporter to the world is largely in the rearview mirror. They need to develop a consumer-led economy, and they need to have a relatively strong currency to compete in the world. given their Silk Road initiatives and desires to compete with the U.S., given their absolutely tragic demographic future. So China, Japan, we could look at the yen here too, and the weakness that we've seen there. To defend their currencies from additional weakness, should they choose to do so, would require outright sales of U.S. treasuries. And so that's yet another supply catalyst in front of us. There's some banking reform where they're talking about capital being long-term debt that would equal to and offset shocks to the system should they come in the future, and so forth. And so if those get put through, there's some more supply pressures in the long end of the curve, and that's, again, when we look at what the market's valued at, we say, Here's a very long-term chart of the S&P 500 forward earnings with a multiple. So in the candlestick chart in there, you see the S&P 500, and what you see here is 10 times earnings, 15 times earnings, 20 and 25. That's largely been the range encapsulating markets through the ups and downs over the years. And you can see back in the trough, we got down to the low single digits in terms of multiples. We only got down to about a 15x multiple on COVID. And when the bubble burst in 2000, the market got down to, again, a 15 multiple on a forward basis. What was different here and here relative to here was your discount factor. So what were long-term interest rates? This red line is the average of the last 30 years of 30-year interest rates. And you can see we're quickly coming up on that average number. And so what is the multiple, or what should it be in a risk-off environment when interest rates are at that level? And the answer is closer to 15. And that's if earnings hold. So the fair value of the S&P 500 is closer to 3280 right now if earnings don't come down, if interest rates stay at this level in the higher for longer. So we've got the Fed this week. We expect them not to change policy. We expect them to leave the door open, still be very hawkish, and still put that higher for longer message in place so that the markets don't start pricing in more easing again. They want that easing priced out of the curve, and they want the flexibility to stimulate should they need to at some point. But mark my words, there's no stimulus coming by way of rate cuts until we see a significant cooling in the labor market. And as of right now, we're not seeing that. So that's the conundrum financial markets are faced with. We should not be trading over 20x earnings. We should be trading much closer to the long-term average of around 16 or 17 at best. And if you're factoring that dividend discount model being long-term interest rates or duration, then we would argue that the multiple at this point should be somewhat closer to 15. If we get a hard landing, earnings comes down as well, and a real bearish scenario is still in front of us, and the market's just not ready for that. So caution remains the word. Where do we see value in the markets? What we didn't like and what we were selling months ago was the precious metal space, and mentioned it a few weeks ago when we first saw the silver name, one of our benchmarks here, Hecla, come down to 4. It bounced there. It could easily get back if rates move higher, under 4. But keep this on your radar and some of the PMs, because when the Fed does set up for a rate cut, these guys are going to absolutely rip higher. So where's value in the market? There are pockets of it. The PMs are setting up nice for that. Have a great week, everyone. And again, Happy New Year to all my Jewish friends out there.